So there's several different ways to value companies. The first way I want to talk about is my favorite way, which is price to earnings, which is valuing a company based on how much it's going to make in the future. Before we go there, what I want to do is I want to tell you how to understand financial ratios in the easiest way possible. For the rest of your life, whenever you see a fraction, I want you to always think the denominator as being the number 1. So what does that mean with respect to PE? Well, what that means is, and what I'll do is I'll also show you how Coca-Cola is valued with a case study very, very soon. So a PE ratio means for every $1 on denominator, how many times that $1 are investors willing to pay? So this is the denominator, which is 1. It's always 1 forever, remember that. And the numerator in this case is 10. So what this means is for every $1 in earnings, okay, investors are willing to pay 10 times that $1, okay, $10 for each $1 in earnings. And so if a company is growing a lot faster, then what happens is investors will pay more than 10 times. They might pay 20 times. And so the faster a company is growing, the higher the price to earnings. So how do you value a company then? Like, how do you know what to value a company at? Well, the rule that people use is they use what's called a PEG ratio. Now, historically, the S&P 500 trades at about 15 times earnings, meaning for every $1 in earnings, investors are paying 15 times, or $15. Hi there. So what happens is the average company in the S&P, historically speaking, grows earnings at 15%. So 15 times earnings divided by 15% is number 1. Remember that. Okay, and that's a price earnings to growth ratio of 1. So if a company is growing at faster than 15% earnings, then it should trade at higher than 15 times earnings. So a company that's growing at, say, 20% earnings, okay, should trade at 20 times earnings. Okay, and this is not a perfect benchmark, but it makes it a lot easier to understand this stuff. So a company that's growing at only 10% should only trade at 10 times earnings. And this is called the price earnings to growth rate, okay, a PEG ratio. So let's look at an example now with Coca-Cola, right? So how do investors value Coca-Cola? Well, we have to look at the PE of Coke and look at the earnings growth as well. And this will not be a perfect science, but I want to do this to impress upon you how easy it is to value companies if you use the price earnings to growth methodology. So if a company is growing at is valued at 10 times earnings, growth is usually 10%. So let's go to Coca-Cola together. And as always, we'll go to my favorite free website, which is finance.yahoo.com. Okay. And the ticker for Coke right here is KO. All right. So Coke right now is trading at 25 times earnings. So let's go and actually look at the financials of Coke here. So we can see right here, okay, this is last year and the year before. We can see right here that Coca-Cola's earnings per share are $2.25 in 2021. And in 2020, it was $1.79. Alexa, what's 2.25 divided by 1.79?
2.25 divided by 1.79 is approximately 1.257.
1.25, so that's about 25% growth. Now, in reality, people look at forwards earnings, not backwards earnings. But this explains it to you. And so a lot of hedge funds, what they'll do is if a company is trading at way above its earnings growth rate, they'll look to short that company, meaning make money if it goes down. Buying a company means going long. Shorting a company is the opposite of that. And so the rule that a lot of hedge funds use is if the PE is twice the earnings growth rate, then it's probably a short. For example, if a company is trading at 10 times earnings, but earnings are only growing at 5%, then it trades at twice the growth rate and it might be a short. Okay, so we talked about price to earnings. Let's now move on to price to revenue. Price to revenue is really, really similar to price to earnings, except in the denominator, you've got revenue. And remember, the denominator is always 1. So if a company has a price to revenue rate of, say, 20 times, That means for every $1 in revenue it has on the denominator, investors are paying 20 times that $1 in revenue. And you do this if a company is not yet profitable. And so a lot of people ask me, hey, what is the going rate? Like, why should I value a company at 15 times revenue or 10 times revenue or 20 times revenue? How do I know? Well, it all depends on the growth rate of that company and the sector. My favorite way to value companies, though, is to look at my PE multiple based on my earnings estimates in 5 or 10 years. And I remember when I used to work in the hedge fund market, I was long LinkedIn, ticker LNKD, before Microsoft bought it and destroyed it. That's right. And I was also long Amazon. And people would tell me, Chris, you're crazy to own those stocks. Those are widow makers. They both trade at well over 100 times earnings. And I would say, no. They trade at 3 times earnings. And they would say, what does that mean? Well, I would say they trade at 3 times my earnings estimates in 10 years. So this is how growth investors stomach the volatility of really expensive companies based on this year's earnings. They value them based on their earnings estimates in 5 or 10 years. And this is something I teach in a lot more detail in my MBA degree program. Go to harounmba.com for more details. All right, let's talk about the third way to value companies, and I'll talk about government policy and the Berlin Wall and why I have this here. The third way to value companies is DCF, discounted cash flow. And I don't like using DCF because there's a lot of independent variables when you value a company based on DCF. And what that means is you value a company based on how much cash you think that company will make every single year into the future. Then you discount all that into today's terms. The reason I don't like using DCF is because between years 1 and 10, you can forecast that. But then 95% of the valuation usually for DCF is something called the terminal value, which is between years 11 and infinity. And there's so many independent variables too when you discount that future cash into today's terms, something called the weighted average cost of capital. And so garbage in, garbage out. If I tell you x plus 1 equals 3, what is x? It's 2, of course. If I tell you x plus 1 plus 3 plus pencil plus remote control from my air conditioner equals 1, what is x? We have no idea. Too many independent variables. So what the heck am I doing having a piece of the Berlin Wall right here? And I got this at Checkpoint Charlie a couple of years ago. The reason I have this is a lot of people don't understand, or they might question governments for giving money to Ukraine and other countries trying to fight communism. Well, if we don't do that, then the economic impact will be horrific for us longer term. So, according to a lot of the top investment banks and economists, the economic impact, not to mention the awful loss of human life, but the economic impact from Russia invading Ukraine is going to be $2 trillion by 2023. We're all feeling it. The global economy would have had a nice soft landing in early 2022, but Putin screwed things up. So I think that within a decade, the economic impact of not fighting communism is going to be at least $10 trillion. So what does this have to do with discounted cash flow? Why am I mentioning this? Because if countries don't help Ukraine, then the long-term economic impact will be catastrophic to everybody. Hopefully that explains DCF in a nutshell and target prices as well.